In this video, we're going to explore rule number 4, price moves in waves. This is quite an important rule. In fact, it's the foundation of how you should look at financial markets. If you're investing in forex, stocks, commodities, crypto, whatever it is, you need to know this rule. It's vitally important. Let's run the numbers. FUD, fear, uncertainty and doubt, and FOMO, fear of missing out, are incredibly real. People, when they get into financial markets, don't understand how price moves in a wave. They think that up moves last forever and down moves last forever. What I'm showing currently is price momentum inside Bitcoin. Bitcoin price momentum is nothing compared to the old coins, but you can see just how volatile Bitcoin is. The real question is what causes every single chart to move in a wave. Market structure exists in every single price chart, and market structure varies by power as well. For example, what we can see here is a high level of market structure at this area, another high level here, and another high level up here. Observe how price actually moved. It overcame structural resistance, converted it into structural support, and then rallied to the next price area. It tried to go higher through this structural resistance, but was rejected back. And what we see is price is continuously moving between structural resistance levels and structural support levels. When we get structural failures, it means we get negative structural attraction back to previous structural support levels. Understanding how and why price is always moving in a wave will make you an absolute fortune inside financial markets, but you must understand it. Levels of structural support exist when the price is higher than that dotted line. Now, what is that dotted line called? It's called a Stanfield level or a CTKS level. It's formed through two levels of standard certification, level 1 and level 2 standard certification, and it accounts for all of price history. When a level of structure exists above price, that is called a structural resistance level. So knowing where your structure is vitally important. Always remember, thicker is stronger, thinner is weaker. Gaps always end up getting filled up to the upside and also to the downside. Because price is always moving in a wave, when you get a positive CTKS gap, this simply means that the levels of structural overhead resistance are so thin, price is likely to explode through them. Inside the crypto market, you get explosive moves upwards and implosive moves downwards. Price is always moving in a wave as it hits a structural resistance level and backs down to structural support levels. If it's not going below, it's going above. If you get a structural pass, you need to know where the structure exists above that. Structural failures are simply an inability to get to a level either above or below. When price cuts through a structural level, it just means it needs more and more structure to slow it down. Structure is not a brick wall, it's a safety net. After big moves, you typically see digestion inside the market and then a decision made. As price is always moving in a wave, it's very important to know where your structural levels are and how price is interacting with that structure as well. What you will typically see inside financial markets is panic. Panic is a normal state of the stock market, a normal state in commodities, forex, and crypto. What panic will do is to cut through a variety of different levels and what it means. If you have a structural failure here and you cut through structural support, it just means that there's a lot of panic. You will need more and more structural safety nets in order to reverse price. But these negative CTKS gaps are typically filled to the upside and vice versa, becoming positive CTKS gaps. Inside these gaps, which we know in advance, you can see how price gets really volatile. As an investor or a trader, because all investors become traders anytime they buy or sell, Taking advantage of these gaps and small percentages is an absolute game changer. A lot of people are after 100x returns. If it doesn't score 100%, it's simply not something worth considering. But there is a different way to earn in excess of what retail thinks is the best possible return. I'll just demonstrate in this particular area. We saw price cataclysmically come down, and we know from the rules of the market that sharp angles reflect. Here, we're looking at about a 3.53% return over around 3 hours, just buying at structure and selling at structure. Now imagine if you could do this just each day. What would that look like in the span of a year? And let's just call it 3%, not 3.5. Let's make it real, and let's go across to Omni Calculator, and it's /finance/percentage return to get to this. So say you put in $100 and you had a 3% return and you did it on a daily basis. That would score a lot of X's if you could do that each and every day. In fact, you would grow your balance up to $4.88 million starting at $100. And this is all from 3% on a daily churn. Now, it does assume that you're putting your entire account in and you're getting this 3% each and every day. Now, what we understand here is that you could take a small amount of money, make a small amount of money, but just do it consistently to create a massive return. If you know where the structure is, you never have to be concerned about price waves moving up and down. It is normal, it is natural. Price just is always moving in a wave. If you know what to do about price moving in a wave, you can make an absolute fortune. And you'll find that you don't need 100 X's in one hit. If you do it slowly, if you know what you're doing, if the structure is visible to you, or if you marked up the structure yourself, that is the superpower that you get inside financial markets. I hope you found this video helpful. Please let me know in the comments how I can help you out. What other knowledge would you like to know about? And if you found the video helpful, please consider subscribing. We have one of the best communities on YouTube.